Between 2007 and 2008, Americans lost more than a quarter of their net worth due to the financial crisis. By early November 2008, a broad U.S. stock index, the S&P 500, was down 45% from its high in 2007. After the housing bubble popped, housing prices had dropped 20% from the high in 2006. Total home equity in the United States, which was valued at $13 trillion at its peak, had dropped to $8.8 trillion by mid-2008 and was still falling in late 2008. The fall in house prices led initially to a fall in the prices of subprime mortgages, which affected the financial market. As a result, in August 2007, the interbank markets experienced huge pressures and central banks had to inject massive liquidity to keep the market circulate. The initial pressure and strain on the financial system spread onto financial institutions after the failure of Lehman Brothers in September 2008. This forced markets to reassess credit risk in the banking system and financial institutions. The financial crisis impacted the banking system on a very large scale. In the United States, 15 banks failed in 2008, while several others were lucky enough to be rescued through government intervention such as the TARP or acquisitions by other banks. As other banks went out of business for subprime mortgage lending, the surviving banks become more careful about the money they lend out. Interest rates get higher. There are also more restrictions for getting loans. A higher down payment is required, and you'll need to have a very good credit to get a good mortgage deal. Even the house prices dropped significantly today. It does not make it easier to buy a house, because it is tightly restricted to take loans from banks to buy houses. As credit drying up, all the convenient exotic loans that allowed almost everyone to buy a new house disappeared. Not so different from buying a house, selling a house is not easy either, because less people have the ability to afford houses, and as a result of the mortgage crisis, there are plenty of foreclosure properties in the market that are priced below market value, which brings heavy competition into the housing market. Failures of large financial institutions and depression in the housing market in the United States due to the subprime mortgages rapidly developed into a major financial crisis, resulting in sharp reductions in the value of stock, which imposed more pressure on the investors. Summing up, being in a financial crisis makes it very difficult for both consumers and firms to make economic decisions, because of the great uncertainty about the economy, such as future price levels and stock market trends, both in short and long terms.